Good day, traders. Your guy is on the screen again. Nathaniel Tunde is my name. I want to teach you something that is very vital to your success, something that I've been missing in your trading right from time that's making you not to make profit or that's making you to lose in the market. Those are the things I want to teach you today. The title of this video is 3 parts to technical analysis. 3 parts to technical analysis. These 3 parts are so essential that traders often ignore them. And as soon as you ignore it, you're going to pay for it. Each time you ignore these 3 parts, you will definitely pay for it. And of course, you know, if a trader has to pay for a mistake or has to pay for ignorance, you know the consequence, guys? You lose your money. Nobody wants to come to the market to lose money. But then you need the knowledge. Without the knowledge, there is no way you can make the money. I often blame people that pursue money first before knowledge. The first thing you're supposed to pursue is knowledge. And then after you pursue after knowledge, all other things will follow, including money. All right. So I'm going to take you through 3 parts to technical analysis that I take extremely serious. And without these 3 parts, I don't even open my screen, guys. Okay, without much talk, let's just go into it straight away. The 3 parts to technical analysis, I'm going to be typing them for you straight away. All right. My 3 parts to technical analysis are 1, structure. All right. 2, phases, market phases, Number 3, entry. All right. Market structure, let me put it that way. Market structure, market phases, entry. These are 3 parts to technical analysis. All right. You may know some of these parts exist, but what if you are not following them? If you are not following them, you're not going to make anything in this market, guys. So let's start from market structure. Okay, market structure. When you talk of market structure, there are a whole lot of things that are involved. All right, it is different. It is not just knowing where the market is going in terms of the trend. That's what is called structure. There are some people, the only thing they know is structure. Is when you have high, higher low, higher high, higher low, higher high, higher low. This is what they thought some people are structure, and that's the only thing they know as structure. That is why when they get to their chart, they are looking for break of structure and they are looking for retest. They are looking for break of structure and they are looking for retest before they take a trade. Experiment from here, guys. How many times do you see structure? How many times do you see this one? Does it even break it to the upside? No. So where is it here? Is it here? Is it here? Where is it going to stop? All right. So you must understand structure. All right. So when you are trying to understand structure, you must understand the flow of the market. Allow the market to give you its flow. Let the market speak to you about what it wants to do. For instance, if we have to look at this Euro JPY right now, we want to look at it in terms of higher time frame. That even though we know that this market, you know, has made a complete structure. Okay, you see this structure, you see this, you see this, you see this. This is zigzag corrective structure, and it is complete with 5. 1, 2, 3, 4, and 5. This wave 5 is complete here, and it has broken this top. Okay, this one has come to 50 to 61.8% of this wave. So this qualify by all guidelines as a zigzag corrective structure. So meaning that we are looking for downside from here. Is that okay now? So now, as you are looking for downside, you now look at it. Okay, you look at it going by what myself and my students have learned. When you have this kind of consolidation here and you have this fast break to the upside, it's just coming to grab liquidity, is coming down. All right, that's a structure that we trade so well in my group. But then, even if we know that it's going to come down, but it's coming down correctively, that's where area of structure comes in. Okay, we have seen very closely that you have an impulse here, you have a three-wave structure here, and you have an impulse here. This is a three-wave correction. Okay, so if this is a three-wave correction, then we should expect that we should get an X that is in the middle before we see these three waves to the downside. Okay, can you see? We are talking of structure. Structure. Have we mentioned anything higher high, higher low here? Have we mentioned lower high, lower low here? We have not mentioned it. Why? Because when you look at your chart, market trends only 10 to 20% of the time. Most of the time, market is sideways and corrective in nature. So you must understand market structure holistically. It's not only when the market is trending up or is trending down that you need to understand, how your structure is. Even in corrective phase, you need to understand the structure of the market. What is the market doing? What is the structure is presenting to us? You can see clearly on a daily time frame. I've analyzed this for you. Maybe I should take it to 4 hours for clarity. Okay, can you see? We have got a 3 waves down. We are expecting a 3 waves up right now as an X. Okay, when you are having an impulse, when you have a 3 waves against the direction of the trend, this time around, you have the trend is up, 3 waves down is called W, and then 3 waves up, 1, 2, and 3. 3 waves up is called X. Then you expect another 3 waves down, which is called Y. When the market gets to this level, we will decide whether we'll go one more upside or we continue to go to the downside. Can you now see? This is structure. This is structure. You must first and foremost understand the structure of the market in terms of the pattern that the market is presenting before you. It is that pattern that will give you a sense of the direction of the market. Do you understand now? So you must understand structure, not only in terms of uptrend or downtrend. Some people, it is only when structure is like this, that's when they will understand it. Can you see? Can you see lower low, lower high, lower low, lower high, lower low, lower high, lower low? If a structure is not like this, they have become confused and they begin to click buy, sell, buy, sell, buy, sell, buy, sell, buy, sell. It does not work like that, guys. You must understand your structure. Okay, do you see this, guys? All right, that's what some people want to see. Unfortunately, it's not every time the market does this kind of thing. It's not every time. Okay, it's not every time. Market doesn't do it every time. Okay, so it doesn't mean that when the market is not doing such, then you should be confused. No, this is why you must learn ELLIOTT wave theory. When you learn ELLIOTT wave theory, guys, some of these patterns will be very easy to identify for you. You'll not only be able to identify them, you'll be able to name them, you'll be able to classify them, you'll be able to put them in the proper perspective, put the market in proper perspective, authoritatively forecast where you think the market will go and trade along in that direction. That is the essence of knowing your structure holistically. not only in terms of higher high, higher low, or lower high, lower low. Is that okay now? That is the first phase, the first part to my technical analysis guide. Know your pattern, know your structure. Okay, that is the first step. The second step, as we listed before, where is it, guys? I've wiped it. Okay, the second step is phases. 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 There are two phases you will see in the market, guys. There is always an impulsive phase, and there's always a corrective phase. Okay, you must ask yourself, after you have recognized your pattern, in this pattern that you recognize, where is the impulsive phase there? Where is the corrective phase? Of course, when you recognize your structure, you must have determined the direction you want to trade. You must have determined the direction you want to trade. Okay, if you want to trade upside to complete this X, for instance, as in the case of Euro JPY here, we want X to get to this level. Okay, so if we want X to get to this level, it means we want to trade to the upside. Okay, so you must have determined your direction in this case. So now you want to ask, which phase are you in the market? Are you in the impulsive phase or are you in the corrective phase? Of course, when you are in the impulsive phase, you don't want to trade the market. First impulsive phase here, you don't want to trade the market because you know, all right, that after this impulsive phase, a corrective phase will enter. And it is only when this corrective phase here is over, that is when you want to trade continuation to the upside. So the first impulse here, you don't touch it, guys. It's not your trade. This correction here, you don't touch it. It's not your trade. This continuation here is your trade, guys. So this is what you're going to replicate in any of your analysis. You're going to replicate it in any of your analysis. All your analysis, rather, replicate it. So right now, here, we have this. We have 3 waves down. We're expecting 3 waves up to get to this level. Okay, it must get to at least 50% of these 3 waves down. Okay, 60 to 61.8, like something here, 61.8. That will be fine. Anywhere here will be fine for this market to fall. Do you understand now? It must get there. Then you should also know, let me just chip in this, that it is not only impulse that you take a fib of. For instance, because I recognize this fact that many guys have been making a lot of mistake about, the misuse of fib. All right, look at this fib here. If you want to know this impulse here, from here to here, you take the impulse, then you are looking for 61.8. Unfortunately, it does not work like that. It's not every impulse that the correction that appear after it, that correction is correcting that impulse. No, this correction here, guys, is not correcting this impulse. So if this correction here is not correcting this impulse, then there is no relationship. Fib bears no relationship between two of them. I don't know if you get what we are saying. This impulse, this impulsive leg to the downside, and this correction that you are seeing has no relationship. Therefore, you cannot come and take the fib of this leg, and you are now looking for this impulse to end at 61.8. It's not going to work that way, guys. It's not going to work that way. So the question now is this: Nat, if that's the case, this correction, what is it correcting? Since it's not correcting this impulse, what is it correcting? It's correcting this 3-wave structure. Okay, this 3-wave structure that caused this move to the downside is being corrected by what? By this corrective structure. So if we have to know the depth of this corrective structure here, what we do is to take the fib of the 3-wave structure to the downside, starting from the start of A to the end of C. Of course, you know that this is wave A here, this is wave B here, and this is wave C here. Okay, so when you now take the fill, you want to target 61.8. Can you see, guys? You want to target this area, 61.8. It can also get to 78. There's no problem. So between this level and this level, you expect this market to form X. This is 3 waves down, W. 3 waves up is X. And then from here, we are going to be targeting a sell to the downside to give us a 3 waves down. Why? Do you get it now? So it's just to chip in that one. So you get to know your structure, and then number 2, you get to know market phases. What phase are we? All right. For instance, this is an impulsive phase. This is an impulsive phase. And I said every phase must be corrected. But this impulsive phase and this impulsive phase, there is a link in between them that is corrective. A, B, and C, with E, C ending as ending diagonal. This is B here, and this is A here. A, B, and C. Then this is impulse again. A, this is correction in 3 waves, B, and this is C. So this ABC down is corrected by this move to the upside. All right, and we expect it to at least break this top to get here around this level, around this 139. We expect Euro JPY to move to the downside. But can you now see that I'm identifying my structure? I'm identifying the phases in the market. Right now, we are in the corrective phase. Okay, we are in the what? Corrective phase. X is generally very corrective in nature. It struggles a lot to complete. You can see this W is very fast down, corrective structure, fast down. But you can see this X, very corrective. It struggles to, to get to the target. That is the characteristic of wave X of a WXY structure. Do you understand now? So you must know, number 1, you must know your structure, must know your pattern. Number 2, you must know your phases. Which phase are you? Are you in the impulsive phase or you are in the corrective phase? And then last but not the least, you must know the level of your entry. You must know the level of your entry. There are some people, they buy at resistance and they sell at support. Can you see? This is where they buy. Why? Because this market is going up. This is where they will buy. Because they see this market is coming down, this is where they will sell. These are the people that market makers are using as liquidity, to get liquidity every time. Huh? We don't want don't want from today the market maker not to use you as liquidity. So if you don't want it, you must pay attention and watch this video to the end. All right. So you must design a system where you can only buy at a discounted rate. We are talking of entry now. Every entry that you are going to get in the market, you must make up your mind that such entry must not come. If you want to buy, it must be at 50% or 61.8%. Look at it here, guys. You know that you are going up. You are going to the upside because I told you X should come to around this level. So if you are coming to around this level, okay, if you are coming to around that level, then this is very strong as impulse. Okay, this, I'm coming, hold on guys. This is very strong. You can say it's an impulse, but do you know that this qualifies as a 3-wave structure, even though it does not break this level or it broke it with 5 pips? It's a 3-wave structure. So you need this move to the upside. So at what point do you get in, guys? If this is impulse, you must target 50 to 61.8% retracement. Can you see? At this level, guys, that's when you're getting 50 to 61.8% retracement. And in most cases, I put my stop loss just below 79% retracement. That's where I put my stop loss. Okay, can you see this market has retraced to this level and it's on its way to the upside? Okay, so at this level, this is an impulse. At this point, market is correcting. You must be able to recognize that market is correcting. Okay, because correction is slower than impulse. Then you must be able, for entry, you must be able to take your fib, take the fib of the impulse, target 50 to 61.8. When market gets there, there will be a reaction for the market to move to the upside. Is that okay now? All right, so let me now show you another example. Another example. Do you see this one has made a move to the upside, right? So that move to the upside, you are not going to get in except you make 50 to 61.8% retracement. Then where is 50 to 61.8% retracement, guys? Look at it here. The market rejected. What happened? Boom, to the upside. All right. So when the market came back, all right, we had the opportunity to get in here, and then we're now going to the upside. Do you see now? Every entry you get for a buy trade, it must come back to what? To the average or below average. For an impulse, is 50%. You understand? You see this? You see this? You want the market to come here. All right, I told you first, you must recognize your structure. After, you must ask yourself a question. What phase are you in the market? Are you in the impulsive phase or you are in the corrective phase? When you are in the impulsive phase, do not trade because it's going to come back. Many of you, you'll be buying here. You are buying breakout. You are buying breakout. You are deceiving yourself. Because this market you are buying, it will still come down and form a corrective structure. So part of your duty as an analyst is to analyze the nature of the corrective structure that is forming. If you see impulse here, let's say you see impulse here, okay, and it's forming a zigzag correction. You know by guideline that a zigzag corrective structure usually come up to 78% fib of the impulse. Look at the impulse. 78% to come here. That's by rule of zigzag. It is only here that you are going to expect a move to the upside. Are you getting it clear now? That's for entry. We are dealing with entry. So assuming it is flat correction, a regular flat correction that you have, you know that every regular flat corrective structure will normally end at between 38% to 50% retracement. Okay, let me add 38% retracement. Let me add 38. Okay. Okay, can you see? Because it is a sideways corrective structure. The only flat corrective structure that actually comes to 50 to 61.8% retracement is if it is expanding flat. Look at it. This is A. This is with A, with B, and then with C. If this wave C, as this wave B has broken the level of this wave A, if wave C can come down to this level here, if you can break this level, it has become expanding flat. It has become expanding flat, and in that case, it's not going to stop at 50% retracement. It can come as far as 61.8% retracement. Are we getting the logic now, guys? Are we getting the logic now? Okay, so that is your entry. If a market does not, if a market does not make impulse and does not make correction, do not get it. You must see impulse and you must see a correction, and the correction must come to 50 to 61.8% retracement. Can you see? Look at it now. All right. First, let's do it. Let's make example of this pair right now, real quick, guys. Okay. Let's check something. All right. Remember what we discussed? When you see a flag like this at resistance, you have to carry out what is called a fake flag test, okay, using divergence. Can you see? It's making a lower low here, and this one is also making a lower low, meaning that this pair is going to come to the downside. So in coming to the downside, next thing, I've recognized the structure, then I have to recognize the phase in the market. In terms of the structure, this consolidation is happening right at resistance after the formation of this three-wave structure. 1, 2, 3, 1, 2, 3, 1, 2, 3, 4, 5. Five-wave structure here. This is a flat, an expanding flat corrective structure. Okay, after this expanding flat corrective structure is forming, you are now seeing this consolidation right at resistance. Whenever it happens like that, this is not going to break to the upside like this. And how do we know it will not break to the upside like that? We carry out this fake flag test. Fake flag test. How do we do it? You see it is part of your structure. You must know your structure, guys. You see this making a lower low. It's not making a higher high. So there is no divergence. Instead, there is convergence. So we have identified the structure. Now the next thing is to identify the phases that we have in the market. Of course, if you look at this one, you see this, and this. This is a corrective structure. It's over. This is very strong and powerful, guys. It's an impulse. Okay. And what did I tell you next? Every impulse you feel it, all right, and you find 50 to 61.8. Can you see? It makes the first leg. It makes second leg. It's going to make the third leg to come here. 50 to 61.8. It is only when it comes to this place that we can look for sell opportunity to the downside. Can you see? We have recognized impulse, we have recognized correction, and even the structure and the pattern inside the correction is a expanding flat corrective structure. We have also identified it. So if we have this market coming up to this level, that will be the right place to sell it to the downside. Do you understand now? So you know, for every market you analyze, you must recognize the structure, you must recognize the phases, the impulsive phase, and the corrective phase, which we call market nature. You must understand the nature of the market. What nature is it assuming now? Is it assuming impulsive phase? Is the nature impulsive or is corrective? If it's impulsive, you have to wait. If it is corrective, you have to wait until the correction comes to what? 61.8. All right. So when the correction comes to 61.8 or 50% retracement, when you get your confirmation, you take the trade to the downside. Okay. So these are my three parts to technical analysis. If you can observe these three parts of technical analysis and follow them and the rules, you will really lose in this market. If you lose, it will be a real mistake. So to make a recap, what are these three parts to technical analysis, guys? Number one, you must know your structure and your pattern. All right, that's number one. Know your structure and your pattern. Running flat. Okay, you have to know your structure and your pattern. Number two, you have to know the nature of the market, the phases of the market, impulsive phase and corrective phase. And number three, you have to know your entry levels. And your entry level must be at 50 to 61.8, always. 50 to 61.8 of the impulse, always. Do you get now? All right, because if you are doing 50 to 61.8 of the impulse for a buy, it means that the market has been properly discounted. When you make a purchase, it has been what? It has been discounted. So you don't have problem with it. Okay. All right. So if it is a sell trade, it means that you must allow 61.8. Like for instance, look at this, guys. After this move, this corrective structure, you have a move to the upside, and then you have a drop. So we are now waiting patiently to have 61.8 of this move. Okay, so 50 to 61.8 is around this level, guys. So we are waiting for this pair to gradually make its way to the upside here. And then we'll grab liquidity from here, and then we sell to the downside. Do you see now? So why can't we say we want to sell or we want to buy at this level? We cannot do that. We can only take action at 61.8. And if the market is not at 61.8, we're not going to make our entry. So these are the three parts to technical analysis that you must take note of: the structure, okay, the market nature, the market structure, the market nature, and the entry. They are very key and very important. So guys, I believe I've been able to show you something today. It's a trick that when you follow it, you're going to make money right in this market. So consider to subscribe to my channel if you like the content. Share the link to other people, and then of course ensure that after each video you watch on this channel, just put a comment there. If you like the video, let me know. If there's any part you don't like, let me know. Whatever, just let me know. It is meant for me to improve on whatever I do. All right, so thank you for watching, guys. See you next time. Peace.